Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's show, I've asked my experts to look at the best value stocks on the market right now and the best stocks out of reporting season. And the group of stocks they've singled out are absolute rippers, and many of them have a lot of upside if these people are right. Now, there's a chart on your screen right now, and this explains to you why I'm interested in value stocks. The dark blue line shows large value stocks after markets crash. So you can see there's a big wedge down both on the light blue and the dark blue lines, but then there's an enormous rebound. And the dark blue line showing value stocks, they're the ones that go the best out of a crash. And because we've been in a crash and we're coming out, we've got a couple of years, most experts think, where value stocks will actually outperform growth stocks. And that's why I'm looking for value stocks right now. So I've asked Julia Lee of Berman Invest and Jun Bei Liu to give us their best investing ideas based on value stocks and what they also saw out of reporting season generally. Basically, the stocks they thought looked really good out of reporting season. And then Paul Rickard will give us his best value stocks, and he also explains what hybrids are and why they might be harder to invest in going forward. That's the show, so let's kick off with Julia Lee from Berman Invest. Thanks for joining us, Julia.
Great to be here, Pete.
Let's just kick off with the stocks you think have reported really well. And you've said in the past that the good reporters invariably can look good going forward. So what ones have stood out on reporting season?
Sure. Well, one we really liked was Charter Hall. And what I like about reporting season is that it gives us an insight not only into the last 12 months, but also what the next 12 months is likely to be. And I guess it gives us an insight into which companies are in an upgrade cycle. And I think Charter Hall's in a really great space at the moment. It's a fund manager in the property space. And when you're looking at a fund manager, you want a combination of increasing funds under management together with increasing asset values. And that's really what you are seeing here at Charter Hall. They came out with a strong set of results, but importantly, their pipeline is also at a record high, which means their development of mostly industrial and commercial assets is at a record high. And that's likely to lead to further growth in future years, which is great to see as well. Having a look across their funds, a number of them are doing well, which means more performance fees in the current half of the year. And also funds under management has been growing quite strongly. So look, we have seen asset values rising in the property space, which basically means property prices have been rising. And that's been great news for a property fund manager like Charter Hall. So not only has the last 12 months been great, but the next 12 months are likely to be great as well, driven by that record pipeline they have in developing those industrial and commercial assets.
And the thing is this, they're going to be a beneficiary from the reopening trade, aren't they? Because some of their assets that might not look as valuable now will be, hopefully, when people start going back to work and occupying offices again.
Yeah, I think the strange thing about this reporting season is that the REITs have been doing relatively well. So the real estate investment trusts, and that's because even though we have seen lockdowns impacting, I guess, on businesses and rent collection and people being in the office, we've seen asset values rising and the property prices rising has been really good for those companies that are in that property space. So property was one area that did perform well during reporting season.
And I guess because of all the scare factors over the last 2 years, a lot of developments haven't gone ahead, so the expected supply is probably less. And given the fact that Australia will keep on growing, it could be demands from foreign organisations to get into the CBDs of Sydney and Melbourne.
Yeah, I think property is a really interesting one. I take your point that there is a lot of disruption in the property space, whether you're looking at office property or even shopping centres. And one company I'm probably avoiding at the moment, even though it's one of those trades which should benefit a little bit coming out of lockdown, is Essentia. That's the owner of the Westfields here in Australia. And the reason for it is that when we do have the reopening, I think it's going to be the retailers that benefit rather than the landlords. The reason I say that, Pete, is pretty sad, but sort of driving to my local supermarket, I'm seeing a lot more stores closing down and with for lease signs. So when you think of that on a bigger basis, I think shopping malls are going to be starting off from a smaller starting base and probably less retailers. And we know that, more supply usually drops prices. So unfortunately, if we see a lot more for lease signs up, well, that's going to mean that rents are probably going to drop in the short term. So rent outlook's not looking that crash hot.
Let's go to your next good reporter.
I like QBE. QBE is one of those ones that usually reports pretty badly, but this time it reported really well. And this is something that we're not only seeing from QBE, but we're seeing from global insurers, so across the world. And what we are seeing is that premiums, that is the cost of insurance, is rising. And globally, we've seen double-digit gains, which is great news for a company like QBE. Now, add into the mix that I guess when you have a look at the amount of claims, it hasn't been rising as fast as those premium increases, which means that margins have been increasing, and that's a really nice position to be in. And look, I think that trend is going to continue. And not only that, QBE Insurance has a large exposure through the investment income part of its portfolio to bond yields. It invests in bonds over in the US and Australia. So at the moment, it's not seeing a huge amount coming from that portfolio, so investment returns. But as interest rates start to rise, the investment income should start to kick in as well. So QBE Insurance, I think it's in an upcycle here, looking pretty good over the next 6 to 12 months.
Okay. Any more reporters, or you want to dive into your value stocks?
The other one, just one more, is Pilbara Minerals. Look, I think lithium's been on fire, and Pilbara Minerals is the same. And look, I really do think that this is going to continue, and that's because electric vehicle and the adoption of electric vehicles is happening a lot faster, which means that the need for lithium is growing a lot faster than anticipated, and there's not enough supply at the moment, which means that pricing should be strong in the short term. I like Pilbara Minerals. We have Orocobre as well, but I like Pilbara because of its growth profile. And over in Western Australia today, it came out with an announcement that it's seeing an increase in its JORC-related resource, and it's going to come out with a more formal estimation of that resource in October. So really driving the valuation of this company. The shares fell today because we did see Mineral Resources selling out of its 5.3% stake to fund its own growth projects. And so we did see some weakness in terms of the share price, but I think this weakness is a chance to pick up some of the lithium stock, Pilbara, relatively cheaply.
Okay, let's go to your value stocks that really look attractive.
Yeah, I mean, value stocks, I guess you're talking about the reopening trades. And when you have a look at reopening, you have to touch on travel. But I don't think all travel is created alike. And that's because, throughout the pandemic, travel companies have dealt with Delta, coronavirus, lockdowns in different ways. We know that Flight Centres shut a lot of its physical stores, so it's going to have a smaller network once reopening happens. We know that Webjet has had a massive recapitalization, so a huge dilution of its shares. The one that we like in the travel space is Qantas. Now, we like Qantas because it's focused really hard on cost cutting, which means it's meaner and leaner. And what happens when companies do this is when demand bounces back, margins are a lot bigger. So Qantas, when we see conditions normalizing, I think will be a much stronger company than actually pre-COVID-19. Add into the mix that it has been concentrating more on profitability of routes rather than capacity. And I think that's a real positive for margins and profitability going forward as well. So look, I wouldn't be surprised to see Qantas trading above $6 in the next 6 months. Webjet, you've got a bit more exposure to the UK as the US. So just watching what that's doing to travel plans. Talking to someone who was in the US last week, and they've been traveling for work over to the UK, over to Europe. But just recently, they've been cancelling some of their work travel plans because of the Delta variant. So just watching the impact that has on the short term. But the other area I like is infrastructure. Look, Sydney Airports has already had a couple of non-binding indicative offers coming through. And I think time is running out for that superannuation consortium to make another offer, because as we get more vaccinated and travel happens, we will see normalization coming to a lot of these infrastructure companies as well. So I like Sydney Airports here. I like Transurban here as well. even though Transurban in the short term does have the risk of a possible capital raising, because we know that the New South Wales government is looking to sell off its stake of the WestConnex project. So I guess a lot of stocks that we've covered off on there, but my favorite, I think, in terms of the travel sector would have to be Qantas. The other one I don't mind is Hello World, because they haven't decreased their franchise and their retail network as much as Flight Centre has during the pandemic.
It's funny when you talk about Hello World, I can't forget that that was once run by Elizabeth Gaines, who left Hello World to go to Fortescue. Of course, that was a fantastic move for her, and she's avoided living through the coronavirus with a company like Hello World. She really won twice there, didn't she?
Yeah, I mean, Fortescue traded ex-dividend today, but fantastic management, I think, with Hello World, and I do like the company. It isn't listed in the ASX 200, so it is a smaller travel business, but I think it will come out of lockdown with like most of its stores intact, which I think is a positive sign.
Thanks for your insights, Julia. Talk to you next week.
Thanks, Pete.
It's Julia Lee. Coming up now is Jun Bei Liu from Tribeca Alpha Plus. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, joining me now is Jun Bei Liu of Tribeca Alpha Plus. Thanks for coming to the program, Jun Bei Liu.
It's always great to be on the show. Thank you, Peter.
All right, so I've asked you to do a couple of things. One is to talk about value stocks that you think are going to do well as the economy progressively opens up. And I know, you and I in the past have talked about Qantas, and last week it went up 20%, in a week. So obviously people that have picked on the fact that things are starting to look better for flying overseas eventually and opening up of borders and whatever. But so what stocks do you think are going to benefit from a reopening of the Aussie economy?
Absolutely. Look, the value end is where you search for, and you do have to look over 2-year period in terms of the earnings, because, company like Qantas, if you look at just 1 year earning, next 12 months, earnings still doesn't look great, still looks a little bit expensive because we have yet to resume flying. So it is very, very cheap on a 2-year view when we return to normal. So you do need to use a more normalized earning. So Qantas is still one that I think that will benefit enormously from reopening of the border. Not only there will be more demand. I think the pent-up demand for overseas travel will be enormous, and also the company has took the opportunity to take out a lot of cost during the last 12 months. So in a sense, the company is in the better shape when we do return to a very high demand period. So that's still very good. There's a couple of other value ones. So Star City SGR is another great one that we should look into or add to the portfolio. I know it's in the gaming space, but it is a very defensive business in the traditional sense, but it's trading very cheap because it was impacted by the lockdown. Not many casinos can be opened, and also the restaurants are all shut. But if we look at Queensland's experience for them, the pickup in demand has been enormous as soon as the lockdown gets lifted. So we think that one will benefit very largely, and it's not expensive, even on the next 12-month earnings. So if you look at the earning into the 2023 numbers, it's on less than 18 times. For a defensive earning business, that is very, very cheap. This compared to Westfarmer on about 30 times. There's other little ones.
Before you go, you're like a machine gun sometimes, the interesting thing about Star is that, okay, the first leg up would be Australians being able to go to the casinos, the restaurants, and all their complexes. Right, the second leg up will be when tourists start coming back from overseas, because that's going to be another leg up, isn't it, for a business like this?
Absolutely. So the demand will be enormous. So first is to travel, the ability for locals to come over, and second is when the border opens up, when other people come through. And there's another catalyst coming up as well. Star owns a lot of property, the hard property, and that is not being revalued. So Star is actually talking about separating out, splitting out some of its property assets into a separate vehicle, and that, in our view, will realize a lot of value for those businesses.
Yeah, good point. Good point. That's what Bunnings basically did with their properties, didn't they?
Yeah, that's right. We'll see more and more companies doing that, especially when the value is not realized. Because if you look at the asset prices around the world for any asset class, they have all gone up. And whereas for some of those reopening stocks, and these value just sort of sitting in there hasn't been unlocked.
Okay, that's it. Now, put the machine gun on again and start firing away.
Well, the next one is a smaller name. That's OML, Outdoor Media. So look, this one is it's on a smaller end, but it is a completely leveraged in terms of earnings to that reopening thematic. Now, outdoor advertising was growing at a above the industry sort of media spend rate in the decade before this this COVID period, simply because it is a better medium. It has digitization. It has attracted a lot of market share out of other medium. Now, COVID hit. Obviously, at the beginning, no one's driving, no one's flying, so all the billboards sort of become redundant. So, they went through a very tough 18-month period. Now, what's changed in the last little while is that OML has raised capital. Balance sheet is very, very strong for it to sustain a period where people still can't yet travel. But what we are seeing is the pent-up demand for media spend is very strong for the next 2 to 18 months, and the level of interest for the outdoor media is very, very high. Before the latest lockdown, we saw a sharp pickup just in the month leading up to the lockdown. That give us confidence that earning would jump very quickly. Share price still yet to be above pre-COVID periods, COVID sort of level. So it's still very cheap relative to global, its global peers, and the industry is more consolidated as well. Omedia is now the largest in this space. So M&A is very high in the space as well. So, it's well positioned and it's not expensive.
Okay. Any more before we put your gun away?
I think there's plenty of those value names, so you can sort of put Crown in that space as well. But of course, there's a bit of a regulatory issues and all of that. That might take a little bit longer to realize its value. But again, it's the same thing. Sitting at $9 is pretty much its asset value, and you're not really paying all that much for licenses. But that's much sort of more deeper value, has a bit more issue relative to Star, which is an easier play.
Okay, and I asked you to give us your best 3 stocks out of reporting season. So what are they?
Yeah, so WiseTech is the one we thought the result is probably one of the best results out of the reporting season. Now, this company, they provide software for, the logistics, global logistics transactions. And it's been, growing very fast over the years. But because it made so many acquisitions over the last few years, I think something close to 40 acquisitions, so its earnings, organic growth has been clouded with acquisitions. So people couldn't work out whether it's really growing. But last 12 months, it's been pretty clean. They literally made one acquisition and it was tiny, and you saw the organic growth of the core products being incredibly strong, and the company is guiding to another 30 to 40% growth for this year. So it's an incredible growth story. Yes, it's on the expensive side, but it makes good margin, and it's that network effect as well as just reopening of the global economy will benefit this business.
Yeah, and Jun Bei Liu, I know Julia Lee has said to me in the past, and so I'll see if you agree, that often when you find a stock that reports really well, and the share price goes up in and around that report, you often find they do well for the ensuing 12 months.
Yeah, that's true. So for reporting season, there's one rule of thumb is follow where the earning is going. If the earnings getting upgraded, that means, there's a very strong underlying business momentum within. So, they may share price jump 20%, it may do nothing for some time, but the business is doing very well. So eventually the earnings will drive the share price higher. So it's one simple rule: just follow where the earnings going. If it gets earnings upgrade, you do want to be in those stocks. WiseTech is one of those. So Hub was another one that we saw. The result was actually a lot better than expected.
Who was that?
Hub 24.
Hub, yep.
Yeah, so people were very worried about, the cost line heading into Hub, because, Net Wealth talk about high cost, and Premium talked about high cost, and Hub came out, cost was higher, but it's not too bad. And if you look at the revenue line, was incredible, and just the sheer momentum that is, sort of flow going into this whole online platform, it just be incredible. We think the September quarter is going to be a very big number for Hub. And it is growing very fast. It's growing 4 times the speed as what Net Wealth is growing at. So we think that's one of the better results, much better than feared post result.
One more.
I was just thinking this one is the result was pretty good, but I do want to add that in. It's kind of value end as well, which is Ramsay. Now, Ramsay is the one that sort of people sort of got left behind a little bit. Don't forget, that is a reopening thematic, this business. Hospitals being impacted, and now we're in lockdown. The hospital does get impacted because no elective surgery. But what has been happening is all the built up in the pent-up demand. Hospital waiting list is going to get longer and longer. So it's certainly something that you do want to have position to. And it's very, very cheap relative to its other healthcare peers. On average, healthcare peers trading on more than 40 times. This one's on low 20s. And this used to be a premium asset. And it is also talking about separation of its asset as well. The hospital asset, which is sitting there over just $1 billion. So there's a lot of value sitting within that group. And we do see that as one of those stronger performers.
Yeah, and it has been a quality company in its lifetime. Yeah, great observations. Thanks for joining us, Jun Bei Liu.
Thank you very much.
Well, joining me now is Paul Rickard of the Switzer Report. And I want to get Paul into 2 areas. One is he's talking about the implications of some law changes that come in October 5, and what it might do to hybrids. And I'll get him to explain what hybrids are. And then I also want his best value stock he thinks that's out there right now that might be good to purchase for future gains. Paul, thanks for joining us.
Thanks, Peter.
All right, so Paul, a lot of people don't understand hybrids. In a nutshell, what's a hybrid?
Yeah, look, it's a bit like the motor car, Peter. We all know what a hybrid car is, I think. Yep. Hybrid security is like a cross between a share and a fixed income security. These are actually, at least in Australia, the things that come to mind are called capital notes. They're issued by the major banks, and they're not a term deposit. They're not a share per se because there's no upside, but they do have share-like risk in the sense that you can lose some or all of your capital if something was to really horrifically go wrong with the bank, but you will get paid a regular quarterly distribution, and that's a little bit higher, or certainly a lot higher than you get if you put the money in the bank, but with more risk. And so they're called capital notes. They're issued by the major banks, and we're getting a whole raft of new issues at the moment, Peter.
Yeah, I've always thought them as being more like a bond, but they could be converted into a share if something goes wrong.
Yeah, look, that's probably exactly what's been the history, Peter, because we haven't seen any converted into a share because nothing has gone wrong, touch wood. In fact, in almost every single case, those investors in bank hybrid securities get their money paid back early. So we haven't seen any of those issues at all, Peter. But potentially, if one of the major banks was to get into serious financial trouble, or there was a crisis in Australian banking, then effectively your fixed income type investment could actually be converted compulsorily into shares, and you end up with a smaller number of ordinary shares. So that's what gives it sort of the equity-like characteristics, I guess. Okay,
and I guess they weren't all that popular when financial planners or just ordinary investors could get 5 or 6% term deposits. But with them not being around, advisors and other people who want fixed income have looked at these hybrids, but they have a degree of risk, and the risk is such that out of the Royal Commission, some changes were proposed. So talk about those changes.
Yeah, look, they weren't actually proposed for this particular security, Peter, but it covers all financial products that come under the issue of a PDS, outside shares. So a product disclosure statement. You invest in a managed fund, you invest in an ETF, you invest in a hybrid security, you invest in, say, a mortgage fund, you get a product disclosure statement.
Yeah.
One of the recommendations of the Royal Commission some years ago was that issuers should say, those are the people who are trying to get you to invest, should actually say who they're designed for and who are the suitable clients to invest in those type of products, and then make sure that they're only actually marketed and distributed to those people that are suitable. Mm. So it's sort of like to define who's the right market, then make sure that they're only sold to those people that are really meet the criteria.
Yeah.
It's called design and distribution obligations. It was actually became law a couple of years ago, but the effective date is the 5th of October this year. And that means every issuer of a managed fund or an exchange traded fund or if that matter, a hybrid security has to actually sit down and work out who they're suitable for, issue what's called a target market distribution statement, in other words, who they should be sold to, and then make sure to the best of his or her abilities that that's the only people who actually end up buying them. So it's quite a big obligation issue, as you're seeing. Basically, anyone who's got a PDS out there at the moment will be issuing a new PDS come the 5th of October. The implications for the hybrid market are interesting, Peter, because they've always been considered to be that extra risky security because they are, in a way, quite complex. They are this cross between equity and debt. And they've got a few other little nuances about them in terms of things like, for example, you can be automatically converted into shares if APRA, says the bank's getting into trouble, and the interest is not cumulative if something goes wrong. So it has a few other little nuances to them, and hybrids have been considered to be, that sort of extra risky category. And of course, what we're seeing, of course, at the moment, Peter, is ahead of this rule change or this law change is a lot of issues coming to the market because issues are getting in ahead of the law. And then no one knows what's going to happen after the 5th of October. It's possible, one scenario is that you won't see these issues made available to retail investors. You'll have to be a sophisticated or a wholesale investor to be eligible. And that will drop the volume of issuance into the market. And maybe you'll see some secondary market changes, maybe some changes in liquidity. If we get less primary issuance, perhaps the secondary market will be less attractive going forward. So not quite sure how it's going to play out, but it's behind some issues occurring right now.
Okay. At the moment, what's the typical yield or interest that people are getting by being in a hybrid, just on average?
Yeah, in the secondary market, if you buy them on the ASX, it's about 2.5%, Peter. So not a lot. No. And that's over the 90-day bank bill rate. And I have to tell you, the 90-day bank bill rate at the moment is 0.01%. So don't get too excited. Yeah. Has been as high, back in the 90s, it got it to over 20%. That just shows you how much interest rates have moved between the recession we had to have in 1990 and 2021. But currently 0.01%. On top of that, you get about 2.5%. That's if you buy them in the secondary market. In the primary market, and these are these new issues, it's actually about 2.9%. So a little more attractive. And of course, it has to be to get people to invest. And we've got 3 issues out there. Macquarie's just come to the market, and both Suncorp and Westpac have got issues that are currently live in the market at the moment. Okay.
So I guess people have to hit their eyes open and make sure they know what they're doing when it comes to hybrids.
Yeah, and just on that, Peter, look, of the 2 issues, I think Westpac's the pick. So it closes on Friday. If you're a Westpac shareholder, you can apply. So there are ways that you can look about, and you can look at my article today in the Switzer report that shows you where you need to go to.
Okay. I've been talking about value stocks today with my previous guests. Paul, what's your notion of a value stock, and what's one out there at the moment you think looks like good value?
I always think of a value stock, Peter, as something that's got a pretty low PE. That's a price earnings ratio. That's on a forecast basis. Probably something that's unloved, and there's probably a couple other metrics you could look at, price to book value, and some more traditional of those financial metrics we all went by so many years ago. And you can look at those sort of ratios. So often they have pretty good dividend yields because they're not growing much, they're returning most of the shareholders, and their price hasn't been going up. So that's meant also that the dividend payout ratio is probably pretty high overall. So that's what I would think as a value stock. And you're right, Peter, look, as you point out, when growth is stronger and you're getting more cyclical growth in the economy, value stocks should do better.
Give us an example of a value stock you think is out there right now.
Well, for the real risk takers, Peter, I'd put AGL in that category as a value stock. Absolutely unloved. It's probably making new lows most days, all for good reasons. Wholesale energy prices have crashed. Companies going through a transition is going to be broken up. That should be a positive. But a lot of people got very burnt on AGL, so I'd say that's one. I think that's a high risk, but I think it's you've got to question how far it can keep going. So I think there's value there. Another one, Peter, I'd say is Horizon. Now, Horizon is the transport company that owns the both above rail and below rail facilities that hauls a lot of the coal in Queensland. It's the old Queensland National Rail. It's also bought a lot of track in WA and in the long haulage business, the haulage of bulk commodities, but most of its revenue is still tied up in the haulage of coal, paying a super attractive dividend yield. It's priced very cheap, very low multiple PE basis. And that's mainly, Peter, because there's a bit of ESG selling around because it's in the coal business, at least it transports coal. And maybe people have been worried about longer term, what are the volume aspects? Because if coal becomes one of those commodities no one wants to touch, what is that going to mean for coal volumes? To be honest, coal prices are through the roof at the moment, Peter. So some of those concerns have probably been put to one side, and that should lead to better volume. But look, I think that's a good value stock, very reliable income, and a good one to look at there, and one that will recover maybe if certainly some of the ESG concerns are just put to one side a little bit.
Okay. All right, Paul, thanks for joining us.
Thanks, Peter.
And that's the show for tonight. Thanks for joining us. If you want to look at my take on value stocks, also go to switzerreport.com.au, take a free trial, and I've looked at 6 stocks that really look like good value, and many of them also have a lot of upside, presumably, if I'm right, and the analysts who I've relied on are right as well. Once again, thanks for joining us. I'll see you on Thursday.